Hi, I'm ReAnn Gonzalez with Edge Home Finance. Does your home need a new roof, an air conditioning system, plumbing repairs, new flooring, or updates to the kitchen or bathrooms? Those projects can get expensive very quickly. Before you put a major home repair on a credit card or take out a high-interest personal loan, it may be worth looking at the equity you have built in your home. Okay, so now let's get into it. Home equity is the difference between what your home may be worth and what you currently owe on it. Depending on your financial situation, that equity may give you a few different ways to pay for repairs or improvements. The first option is a home equity line of credit, commonly called a HELOC. A HELOC works somewhat like a revolving line of credit, secured by your home. You can borrow funds as you need them, repay the balance, and potentially use the available line again during the draw period. This may work well when you are completing repairs in phases. For example, you may replace the roof now, update the flooring several months later, and remodel the kitchen next year. Instead of borrowing the full amount at one time, a HELOC may allow you to draw money as each project is completed. However, most HELOCs have adjustable interest rates. That means the payment and interest rate may change over time. You need to understand how the payment is calculated and what it could become before moving forward. Another option is a first-lien cash-out refinance. With a cash-out refinance, you replace your current mortgage with a new, larger mortgage and receive a portion of your available equity in cash. This may make more sense for a larger renovation, such as replacing several major systems, completing a full kitchen remodel, or making extensive repairs throughout the property. A cash-out refinance may also be considered when a homeowner wants to complete repairs and consolidate other high-interest debt at the same time. However, you should not automatically refinance just because equity is available. Your current mortgage rate, new mortgage rate, closing costs, loan term, monthly payment, total interest, and long-term plans all need to be reviewed. You may have a very low mortgage rate that is worth protecting. In that situation, a HELOC or another second lien option could be better. On the other hand, if you are carrying substantial credit card or personal loan debt in addition to needing repairs, a first lien cash out refinance could potentially improve your overall monthly cash flow, even when the mortgage rate is higher than your current rate. The important thing is to compare the full financial picture. We should look at your estimated home value, your current mortgage balance and interest rate, the amount needed for the repairs, your credit card or personal loan balances, the payments and interest rates on those debts, and how long you expect to stay in the home. Home equity is not free money. It is a debt secured by your home, so it needs to be used carefully and for a clear purpose. But when the money is being used for necessary repairs, improvements that protect the property, or a well-planned renovation, it may be a better option than charging thousands of dollars to a high-interest credit card. Before you put a roof, air conditioning system, kitchen remodel, or other major repair on a credit card, let's look at whether your home equity gives you a better option. I can compare a HELOC, a first lien cash out refinance, and the cost of keeping the debt on your credit cards or personal loans. The goal is not simply to borrow money. The goal is to find the option that makes the most sense for your payment, your budget, and your long-term plans. Before you go, Please like this video, share it with someone who may be considering home repairs, and subscribe for more mortgage tips and information. I'm ReAnn Gonzalez with Edge Home Finance. Reach out by phone or text and we can review your numbers together.